Welcome to the State of Finance. Today we have Zach. Zach is a credit advisor and mortgage broker for Shore Financial. Hello, Zach. How are you?
Very well, Abby. Thanks for having me on. How are you?
I'm good, thank you. Before we begin, I'd like to mention he's one of the most hardworking guys I've seen. He's very professional, but yet he's very approachable. So with that, high baseline established, Zach, so just tell us about yourself and Shore Financial.
Yeah, thank you. Look, myself, I've come to Shore Financial in the last few years, and prior to that, I was in a construction management background, and I guess Shore Financial has been in business for 11 years, and they've grown to be the number one brokerage in the industry for the last 8 years in a row.
Wow.
As an independent. So one office with about 35 brokers, and we've got about the same, if not more, in support staff. And yeah, based on the volumes that we write and some of our processes, we are recognized for that as the leader in the industry.
Oh, that's amazing. Right. So just kicking off things, just getting to the bare basics. Zach, what is a mortgage broker for the people who don't know?
Thanks, Abby. A mortgage broker is a client representative. So as a broker, I've got 75 lenders on my panel, and it's my job to understand the needs and requirements, goals and objectives of anyone that I'm dealing with from a property finance perspective, to represent them on behalf in front of all my lenders to deliver them a suitable product to achieve their goals.
Or when you say product, it's the mortgage, I'm assuming. So if I'm in the market for buying a property, I would reach out to you rather than going to my bank. I see a lot of clients and a lot of my friends, they're very loyal to their banks. They're like, you know what, we've been with this bank for like, I don't know, 100 years, and I have good relations with the banker or the manager. So is that a good way of looking at things? Or
A lot of people do have that mentality in that, they've done a lot of their banking with a particular bank, all their transaction accounts are there, all their savings account. They might have an existing mortgage, they might have some business lending, so to speak. Um, I guess the advantage of having a broker, or at least consulting a broker, is having access to the market. Everyone's got their day-to-day jobs, and I suppose you might have time to go around and understand two, three, maybe four lenders on your own. Whereas my day-to-day job is understanding up to 75 of those lenders and their policies. So when someone comes to me, yes, they might have that existing relationship, but I suppose the market that I've got access to really commands competition in that there might be a better offer out there than your existing bank.
wow, and there's I've heard banks are more, attracted to a new client, and there's something called as a loyalty tax that we were talking the other day about. Can you talk more about that, Zach?
Yeah, look, I mean, depending on what you are doing at the bank, especially regarding aggregate debt. So if you have a large loan amount or, combined loans that equal a certain amount, you might be eligible or open to significant pricing discounts on your mortgages or your loans. But generally speaking, the banks are the most loyal to a new customer. And by that, I mean someone who is walking in their door. So, if you haven't been at that bank before or you've just switched from another bank, generally you're going to get the most efficient loan product in terms of rate, cost, and potentially other things.
Right. So what is your relationship with the client as well as the bank?
Great question. So my relationship with the client is in person, and it's really up to me to understand their financial scenario
Yep.
because I have to, and I'm legally bound by best interest duty, um,
Mm.
to ensure that there's a loan product or a mortgage that's not unsuitable for what they're trying to achieve. Um, in terms of my relationship with the bank, well, the bank pays me. So whilst I do have the client in my best interests and I represent the client. It's a no cost service for the client.
Wow.
And in terms of what I do with the lender, it's me representing the client and what their scenario, their story, as I said, what their goals and objectives are for what they're trying to do. And it's up to me to make the bank understand that and match them in terms of their policy.
I think this is very important information for people who are listening that mortgage brokers don't charge them. They actually get paid by the bank. So I don't think there's any reason for not getting a mortgage broker engaged in your case.
Yeah, absolutely. And I think fun fact, I think it's about 74% of all residential mortgages are done through mortgage brokers.
Okay.
So, I think a lot of people are sort of the understanding that it's in their best interest to understand the market that a broker has access to. So, um, yeah, it's definitely worthwhile having someone like a broker on your team because you do have access to that market.
Sure. And the fees that the banks pay you guys, is that upfront, or do you get like detailed benefits in the following years as well?
So we get an upfront commission
Mm.
for when and if we settle a loan. So
Yep.
on that day, shortly thereafter, the bank will pay us for settling that loan and then ongoing for the lifetime of that loan or for the time that that person has that particular loan with that particular bank. We get what's known as a trail commission,
Yep.
and that's essentially for client management. It's for our service to our client to manage, again, their best interest ongoing from that settlement date, which can include things such as monitoring their mortgage, ensuring they're on the best rate, repricing that if they feel that they're not on the best deal, or if we see that maybe the bank has lifted their rate, or if they do have a change in circumstance. One of the most common things that I do every 6 months with any particular client is that we review their existing lending and we reprice their loan. We might also conduct a free valuation with that bank to see that the property value has held its value or increased in value, and in turn reduced the LVR, so the loan to value ratio against what any current valuation stacks
Yep.
up on that property, is generally a good way to reprice a loan.
Mm. With that trailing commission part, right? I'll get back to you, Zach. But now, say it's the initial phase. I've decided to get into the property market. What is the procedure? So I contact you. So what are the next steps?
Yeah, so if I meet a new client
Yep.
and they get in touch and they've got a goal of purchasing a property, we'll have a meeting. Sometimes like this, I do meet a lot of my clients in person, but I think since COVID, it changed the industry in that it's very acceptable to have face-to-face meetings like
Yeah.
this over Zoom, and I'll understand about their scenario. I'll have a discussion about, if they're married, where they live, what they're trying to do, what they do for work. And then what we'll do is we'll go through a client form together,
Yep.
and they will have the opportunity to explain their financial scenario in terms of assets, income, expenses, and liabilities. And they're really the key data that I understand in that part of the process to
Mm.
then crunch the numbers on what their borrowing capacity might be. So a lot of the time, um, I get people asking, "I'd like to know my borrowing capacity. I'd like to get ready to go into the property market." So I'll share that client form with them, and then the next step is for them to complete that, upload some documentation for me to verify that information, and then I'll give them a credit proposal which outlines, 2 to 3 lending options for their scenario. After they've explained to me what their financial position is and what they're trying to do, then we'll have another meeting to discuss those options, and I'll make a recommendation. And from there, it's really up to the client in terms of their understanding. If they have any questions,
Yep.
I'm there to answer them, and yeah, then proceed.
So the first step is basically doing all the numbers, saying, hey, this much is your income. and these are the expenses. Do you look at the expenses as actuals, or is there, an allowance that, like 40% of the income should be, written off as expenses or something like that? And obviously, then is there any buffer on top of it that the banks keep as a safety net?
Yeah, good question. So I do take expenses as they are. So we
Yep.
request 3 months of bank statements for living expenses. So what you spend day to day at the supermarket, out for dinner, on petrol, this and that. And we take them as they are, and then we go through the expenses to make sure that there's um, no surprises. There's an appropriate level of discretionary spending. Obviously, no one's particularly by the book. Everyone has, a few Uber Eats. Everyone,
Mm,
goes out and has those discretionary items. But yes, you're right. The bank does have a set methodology on what they expect people to spend, and that's based on where you live, what your income is, what your marital status is, and the bank will say that, right, we expect that someone like yourself might spend $3,500 a month on
yep.
living expenses, and that'll include things like food, transport, clothing and personal care. Um, there might be some, gym memberships and health related stuff in there. Then you've got, say, if you live in an apartment, there's strata fees, private health, and depending on the lender, they're included or excluded in their standardized set of modeling. So if the bank expects you to spend $3,500 per month, but you're pretty frugal and you spend $2,000 a month,
Yep.
as a mitigant, the bank's still going to include you at that 3,500 regardless of your expenses. So
Wow, that's
um,
brutal.
I guess what that impacts is your borrowing capacity. So expense after income means that you have a certain amount to contribute to your mortgage, and therefore the bank will lend you a certain amount.
Do you have any examples, like say a certain bank does a certain percentage,
It's not
like
really a
like without naming the
percentage.
bank, if that's an issue?
Yeah, sure. So I mean, it's not really a percentage based assessment. It's based on your marital status, your income,
Oh,
where
okay.
you Um, it honestly varies person to person based on what their scenario is. I suppose an example I could give is that there's lenders that include strata fees, for example, or investment property costs inside that figure that they expect you to spend.
Yep.
Um, whereas other banks, they would add that on top.
Oh, okay.
So then that further reduces your
Mm.
borrowing capacity.
Well, so what are the other pitfalls that the clients get into that affects or hinders their borrowing power?
So I think one of the main things is unsecured debt. If someone's coming to me and they're a first home buyer, but they have a credit file, they've got a credit card, or they might have a car loan or a personal loan. Um, Generally unsecured debt in the form of those sorts of things, it does hinder borrowing capacity. Rule of thumb, every $10,000 of unsecured debt takes about 40 to 50,000 off your borrowing capacity. So, if you have a
That's
$10,000,
huge.
yeah, exactly. If you have a $20,000 credit card, then your borrowing capacity might be worse off by around $100,000.
And just let me make it clear. This is the limit, or do you know what I mean? Like if I'm given a limit, 10,000, but I don't utilize it, I just spent 5,000, say, a month on that credit card. So is that 5,000 we're looking at, or the 10,000, which is the upper limit?
Yeah, correct. So it's the limit. It's the availability to spend. So it's the available debt limit that you have. You might pay off your credit card to zero
Yeah.
every month, but if it's a limit of 10,000, the bank will take it on that worst case of you maxing out that credit card.
No, that's brutal. So, I think yeah, a good strategy would be to maybe just get it to the lowest level, like a few months before you're applying or checking your borrowing power.
Yeah, exactly. I mean, and we can generally have that discussion with the client if they
Mm,
come to us, they've got, one credit card or two credit cards, or they've got a car loan. We can give them give them the advice that says, here's what it looks like as is,
yep.
and here's what it looks like without. So if you close this, if you close that, probably another one is hex debt, university debt. That's probably a dollar for dollar impact in terms of your borrowing capacity. And then, if you do have any existing mortgages, if they're for your owner occupied residence, they're, you know, not generating any income, you're not getting any negative gearing benefits
Mm.
on that side of lending. But if it's an investment property, uh, that can be advantageous in terms of it doesn't cancel itself out from your borrowing capacity limit.
So I'm assuming when you are, say, you're not, you're approaching a mortgage broker for not your owner occupied, but an investment, the income from that investment would add to the potential income, and that would enhance your borrowing capacity.
Exactly. So borrowing capacity is directly related to income.
Yeah,
So the more income you have, essentially the more that you can borrow. Um, and yes, where it comes down is based on your existing debt limits.
sure. So Zach, is that process same for everyone? Say if I'm a first home buyer or an investor. With investor, I think you pretty much answered it. There is an additional layer of the future income that it would generate. But on the whole, for a first home buyer, or maybe someone who's maybe looking to upsize or maybe refinance. So is the overall
Yeah,
process?
it is the same process. At the end of the day, for any credit advice, for any lending advice, we need to conduct our own assessment of someone's scenario. So if you're a first home buyer, if you're upsizing, if you're downsizing, if you're investing, we need to know the same details, because at the end of the day, if you want to borrow money, we have to understand your income
Yeah,
and anything else behind that, existing debts, any spouse, what your job is, etc. So it's the same process for everyone. There's really no exceptions for anyone being treated differently.
yeah,
Follows the same process every time.
cool. So since you've been in this space for a long time now, if you had some tips for, say, first home buyers, what would that be?
I'd say reduce or minimize your unsecured debt. So as we talked about before, if you have a $10,000 credit card limit, but you only say use $5,000 of that, reduce that within your means. Work on your savings, work on your income, and yeah, I guess consider how you're working and living within your means in terms of what your goals and requirements are. But I suppose it takes a consultation with someone like myself to actually
Yeah,
realize where they stand.
yeah.
Um,
Obviously,
I
this
think
is
that
a general advice only.
yeah,
Just putting it out there. We're just two dudes talking on YouTube. So if someone has to, have a tailor-made, any package, or they need some advice, they should reach out to, their accountants or people like yourself, Zach. Yeah, this is just general purpose advice. Just putting a disclaimer just in case. Yeah,
yeah, very good, very good. I think one of the things that's open for first home buyers is the first home super saver scheme,
yeah,
which not too many people know about, but basically you can talk to your employer and you can make additional contributions to your superannuation fund, and obviously that is pre-tax. So you get the benefit of pre-tax income going into your super fund,
yeah.
and I think it's up to around $50,000 that you can take out if you've been contributing additional funds for 1, 2, maybe 3 years,
Okay.
and provided that is for the purpose of purchasing your first home, you can then
Right.
access that from your super fund up to the amount that you've been making additional contributions for.
So that goes into the super and gets taxed at a lower rate in the super environment, right? 15%. So
That's
you
right.
have more in hand now. All right, that's pretty handy. What other assistance? Sorry, Zach.
Yeah, the other schemes, there's a national and a state level scheme. The national scheme through Housing Australia is the low deposit scheme. There's one for, um, I guess, regular purchases in a metro area. There's a regional version of that scheme as well. There's a family oriented scheme where if you have a low deposit, you could purchase with as little as a 5% deposit um, up to about $900,000 in property value.
Hmm.
So that's nationwide,
Yep.
and there's around about 32 to 33 lenders on the panel that will allow you a mortgage for that 95% of the value of the property. So that's pretty handy. There are certain eligibility requirements that need to be met, but you can talk to someone like me to
Yep.
find that out. Then there's state-based schemes around stamp duty concessions for first home buyers. And I think that they're actually getting updated in the new financial year for people who haven't owned property for 10 years. So whilst you might be a first home buyer, if you also haven't owned property in the last 10 years, you might be eligible for a stamp duty discount.
Oh,
Um,
so that's upcoming. There's
yeah,
something
I
in the
mean,
pipeline.
it's been existing for years. But they've changed the limits around it. It used to be 600,000. Now, if you purchase at a value of 800,000 and you're a first home buyer, you don't pay any stamp duty on that property as long as you live in that property for the first 12 months. And above 800 to a value of 1 million, you'll get a concessional rate. So you'll get a discount on the stamp duty.
Yeah.
There are a couple of things that are available. And yeah, I mean, they involve the lenders, and I guess it's really targeting those first home buyers, that lower demographic, that lower age demographic, I should say, for
Mm.
people to get into the market. I guess an astonishing fact is that the average age of a first home buyer is 39 years old. So
Is that
there's
New South Wales or Australia wide?
Australia wide.
That's not good.
It's something that it doesn't quite make sense, but I guess it does. It is pretty astonishing in the fact that by the time you're maybe that age, you might have a partner, you might have an
Mm.
income level that supports a
Yeah.
higher purchase price. So I guess for a majority of people, these government incentives actually miss the mark in terms of where their income might be or what
Mm.
their situation might be.
Yeah. And also in these recent years with this social media, there's a lot of emphasis on people renting all their lives. They're like, we just rent and it doesn't make sense on an Excel sheet. But I think it makes so much sense, especially when you're in your 30s to, just get your own house or get your own apartment. Maybe start small. It doesn't have to be your dream house.
Exactly right.
Yeah. All right. So, with all of that, I mean, you proposed there are a lot of schemes, and you do all the numbers. So, is there any thin, very fine line between the advice that mortgage broker gives and any financial advice? So, where do you draw that line?
Yeah, so as you gave the introduction, I'm a credit advisor, so I don't give financial advice, but I guess specifically to Shore Financial, we do have financial advisors in-house. So
Okay.
that's, I guess, a value add for our service is that, if people are looking for that specific financial advice or investment advice, we have, I think it's 5 financial planners in-house. So we can certainly help the client on that front as well. But um, in terms of my service, it's credit advice. So any lending um, I can advise on. I can give scenarios on what people would like to do and how that might work in terms of their situation. But I can't tell people to go and invest or go and buy this, or
Uh,
I can't actually tell them to do that. I can only give them the advice to their scenario on what lending products are available to them.
right, that's good to know. Okay, so now that was more targeted towards first home buyers. We have a lot of audience, a large audience that are professionals. So is there anything specifically tailored for professionals? Could they could be from any field.
Yeah, so there are a few lenders on my panel that's and then major bank lenders as well that offer certain packages, lending options to professionals. So, that might be medical, legal, and accounting, um, to name a few. That depending on your registration, if you're a certified practicing accountant,
Yep.
if you're currently active, currently registered, um, you might be eligible for lending products that allow you to borrow at a higher limit without paying extra fees. And typically, the extra fee associated with lending at a higher limit is lender's mortgage insurance.
Oh yeah,
So
that's a killer.
LMI, as it's known, it can be between 1.8 and 2.3% of the loan amount, depending on how much of the value of the property you're
Mm,
asking to lend. So, um, being an accountant like yourself, you might be eligible for a package at one of the major banks who offers these products for owner-occupied purposes or investment purposes. You can lend, 95% of that value of the property without paying those extra fees.
that's pretty handy. So for the listeners out there, if you are, if you're a professional, if you are associated with any professional body, it might be worth having a chat with your mortgage broker and seeing what incentives are available in your case. Thank you for that, Zach. All
Yeah,
right.
no problem. Absolutely.
Yeah. Do you have any exciting example that you've come across lately that you would want to share with someone, which is, also educational in a way?
Yeah, I think back to maybe how I get paid and what I'm paid for after settlement in terms of that trailing commission.
Yeah.
Um, as I said, every 6 months we will check in with our clients and review their lending. I had a client that purchased a property a little over a year ago, and they purchased at, I think it was about an 88% loan to value ratio. So, um, touching on that lender's mortgage insurance category, that kicks in above 80%. So at 88%, they had to pay lender's mortgage insurance because, they had a certain deposit amount and they needed the rest for the property. And in the last year, we've checked in with them at 6 months and we've just checked in with them again.
Yeah.
And we've done a valuation on their property. And that valuation was at no cost to my client. It was arranged with the bank free of charge. And we basically realized that the value of the property has gone up 160 or $70,000 in the last year.
Oof.
And yeah, it's great result for them. It was a very, very happy Friday for them when I told them the result, and even more so that their loan balance coupled with the reevaluated position of the property,
Yeah.
it had put them out of lender's mortgage insurance territory. So it
Mm.
brought their loan to value ratio down beneath 80%. And what's attributed with higher LVR lending is an additional rate. So it is more expensive, regardless of the LMI fee. You've actually got a loaded rate for that higher tier of lending.
Oh,
So
okay.
take them out of that tier of lending, we reduce their rate and in turn reduce their interest payments. So that was a good result for them.
Mm.
And I guess a scenario that I'm, all too familiar with in terms of the service that I deliver to my clients ongoing.
That's pretty cool. And even a small percentage, right? It would sound small, like 0.2% or point zero some percent, right? But on a large mortgage, say on $1 million, that saves you thousands in a financial year. Yeah. However,
in
it might
interest.
sound very small, right? Sorry, Zach.
Yeah, exactly. So I mean, there's obviously been a big market for refinancing at the moment and in the last year. Um,
So that's a current trend you're observing? Because my next questions were around current trends.
yeah, look, there's been a fair bit of refinancing,
Yeah.
and I suppose to look at, say, $1 million mortgage, if you were to get a discount or achieve a discount of 0.5%, it might equate to around $5,000 in interest savings in 1 year. And if you achieved a full percent, closer to that 10,000 in interest savings. So, yeah, that's definitely a current trend that we've been seeing a lot of at the moment. Um, Obviously, still a lot of first home buyers. I think there have been some adjustments to what they can borrow. Unfortunately, the rate rises have impacted a lot of people in terms of their borrowing capacity, but there's still a lot of people out there trying to get into the market. Um, Two of the key categories of people that we're seeing, or demographics of people that we're seeing at the moment, are upsizers and downsizers. They seem to be competing quite a lot in the property market. And I mean, the downsizers, they're not really rate conscious because they might have sold a big house and
Yeah.
they're
Made
patched
big
up.
bucks.
They want what they want and they're willing to
Yeah.
pay for it. So they're probably a little bit more bullish on the side of bidding for properties and achieving their goals. As are some of the upsizers. So people who might have a property or one investment, or they're looking to use what they've got or sell a property and upsize. So going from a 2 bedroom to a 3 bedroom, so to speak. I suppose another scenario recently was a client of mine. They moved out of their first purchase and they wanted to know about a refinance opportunity. And we did the same thing as I said before. We did a valuation and we looked to reprice their loan. The valuation revealed that they actually had significantly more equity in their property.
Mm.
And because they were at that, you know, mid to late 30s, they're in the engine room of their career. So,
Yeah.
they're again not too concerned about the rate, although it does factor in. But being in that point in the career, they're ready to take on what they need to improve their life, to achieve their goals. So we were able to keep their first purchase, their first property, use proposed rental income because they were looking to upsize and keep the first one. So we got a rental appraisal done to say what that could be rented out for. And
Yeah.
with the equity and some savings, they were able to purchase a 3 bedroom apartment and essentially upgrade their life and achieve their goals and grow their property portfolio, which was a good result.
That's amazing. And coming to apartments, seen a lot of, surge in the apartment market now, contrasting to last few years when people were like, oh, don't invest in apartments. So I'm sure you must have seen a lot of people rabbit, more leaning towards apartments these days.
Yeah, I suppose it depends where they are, and again, of course, about their goals and objectives. But I think the price point is really what's grabbing people's interest in
Mm,
the apartment market. I definitely do a lot of residential lending for apartments and people wanting to move in apartments. Whilst houses have traditionally held their value, like house and land standalone, have held their value um, with less volatility in the property market than apartments. I think, yeah, it's the price point that people are attracted to with some of the inner city apartment living, because it allows them to be closer to that amenity.
very
And
convenient.
yeah, I think the entry point for apartments obviously captures a broader range of the market for home buyers. People have their own goals and objectives. They might be able to borrow a certain amount, and if they want to stay in a certain area, then they might be looking at apartments rather than houses. Again, it's circumstantial. I suppose what's notable is that houses have traditionally held their value with a lower degree of volatility
Yep.
over the years. But apartments do see a greater degree of ebb and flow in their value, and the market conditions impacting their performance. But I think, as I said, the price point is more attractive because it is on the lower price side of things. But
Yep.
again, it does come down to someone's circumstances, to what they're after, where they want to live, how many kids they might have, or what their spouse is. And yeah, I suppose we see a fair mix of them in terms of houses and apartments, investor and owner occupied. I think in Sydney specifically, the yields on apartments are slightly better performing, and that's again down to that price point. That demonstrates maybe a greater investment value in certain areas.
Mm. With these apartments, Zach, there's a bit of a dilemma. Although while we have a lower, the entry price, you might call it, but at the same time, many banks they don't need the 5% or 10%. They ask for a higher deposit. Is that a challenge at the moment?
Um, Again, circumstantial, depending on the client. So,
Mm.
borrowing capacity is related to income, and in many investment scenarios,
Yeah.
people tend to uh, leverage higher, so they get a 90% loan, or that they'll go into LMI for that investment purchase because it means that they might use less of their cash.
Mm.
I suppose in an investment scenario, there are potential tax benefits from all the costs associated with an investment property.
Yep.
And lender's mortgage insurance is one of the costs associated. So that becomes potentially an advantage to someone's income, depending on their structure, whatever their accountant advises them. That being a cost of investment, it can impact their taxable income. Again, I'm not an accountant. I'm a
Yep.
credit advisor, so always check that with your accountant in terms
Yep.
of what your investment scenario is. But in terms of that lower deposit, um, again, it really depends. The banks will allow you to lend at that higher limit, but it does cost more
Mm. But don't the banks see them as higher risk because there's a high supply and they value them lower?
in
Hence they
terms of
ask.
time.
Yeah. Because I've heard that
So
from many of my friends, and even I was in the market once, and the banks asked for a higher deposit, which again, being lower price but higher deposit, if someone's getting into the property market, they might not have that much cash with them.
yeah, so the banks have, I guess, exposure limits. So
Mm.
say if you're buying in, a block of 10 units
Right.
versus buying in a block of 200 units.
Mm.
Um, there's a couple of different things that the banks will consider there. One is how many units in that apartment complex does the bank already have security over? They might not want any other units in that development
Uh,
because they have too many. The other thing being that if you're in a block of 10 units versus a block of 200, well, there might be there's a varying degree of how your unit might perform and how the bank sees it as an asset in terms of its risk profile. So in the
mm.
mix 200, there's maybe a different level of how it might grow in value, and versus say something in an older block of units
Yep.
that's built back in the 80s, it's double
Mm.
brick. Um, there's uh, a higher value maybe associated with it because it's more independent in that it's not surrounded by a bunch of other units. If that sort of makes sense. So yes, the banks will ask for a higher deposit
Yeah.
depending on the density.
Mm. More the
There's
supply or how it's built and when it was built. So all of these factors come into play then.
Yeah, for sure. I think the simplest way to say it is there are density restrictions. So
Mm.
some banks will require a 30% deposit depending on if it's over 6 stories in terms of the apartment complex, if it's over
Mm.
50 units in the development. Um, Other banks will allow you to do um, a 10% deposit, a 15% deposit. It varies lender to lender, but there
Yeah.
are certain restrictions depending on the density of the complex that the asset is in.
Since you mentioned density requirements and restrictions, uh, is the government doing anything to, restructure the density, if that's even a word, like restructure or maybe rezone, or they're doing anything about, improving the situation?
Yeah, I think so. The housing supply seems to be a very common topic at the moment, and
Mm.
something that's driving up rents. It's driving up prices because we've got, I guess, incoming migration and
Yeah.
population growth, and with an undersupply of housing, it is what's bolstering the prices in the market at the moment. Um, I guess what I've heard is that from a state level in New South Wales, which is where we're both talking at the
Yep.
moment, there are some government changes to zonings to allow more medium density development. Speaking with a couple of town planning contacts that I work with, they're seeing a lot of inquiry at the moment because of these changes, and they're predominantly around transport nodes, so train
Mm.
stations, bus stations, um, places that have that amenity or that connectivity to the transport into the city.
Yeah.
They're allowing increased density, and by that I mean you might have a site in that's currently got some townhouses on it, and maybe they've approved it, they've rezoned it to allow higher density, meaning that there's maybe a residential apartment building going up there, so a few more levels. There might be 10, 15, 20 stories. A good example of that is around Crow's Nest and Linfield,
Mm.
um, around the train stations in both of those locations. And I think more so to the fact that, um, there are some significant land holdings that, some people might want to redevelop, put a duplex on their house. Instead of
Yeah.
having one dwelling, they're putting two dwellings. So I think the state government's looking to revise their planning instruments to allow more of this without, the traditional process of going to council, getting a development approval, which can take time.
Yeah.
Um, Obviously, the housing supply isn't something that they can solve overnight,
Mm.
because it does require the construction of new dwellings, and that's a 2-year process at least.
Oh yeah. Yeah. With the budget as well, they're estimating more than the need for, 1.2 million, if I remember correctly, by 2030.
Yeah, over the
Yeah.
next few years, there's, we're still tipped to be in deficit for what the
Yeah.
housing requirements are for the
Yeah.
population.
Even if they've cut the migration by into half, but yeah, still, I don't know how realistic that is, but yeah, future will tell.
Time always tells, so we
Yes.
can we'll have the power of hindsight once it comes around. But yeah, it's a funny point because everybody wants the outlook, they want the projection. No
Mm,
one's got a crystal ball, but we can always look in retrospect.
yeah, yeah. All right. Continuing the current trends, Zach, do you see, because of this interest hike and interests being steady and all the apprehension around the interest rates, what kind of loan structure are you, experiencing more with the with your clients? Is that more towards variable or fixed? How's the outlook in just your case?
Yeah, so a lot of the lending that we're doing at the moment is on variable rates, and that gives the opportunity for when rates come down for
Yeah.
the client to benefit of a lower rate that may be passed on by the bank. Um, Looking at the fixed rate mortgages, they obviously exist, but a lot of people aren't going for the fixed rates at the moment. Um, Looking at lenders offering 3-year fixed rates, so meaning that you are locked into that particular rate for 3 years.
Mm.
There are a couple of products, mortgages, I should say, that they do offer a lower rate for 3 years, um, but that's, I guess, down to the judgment of the client in that if you'd like security of knowing how much exactly your repayments are going to be month on month, and for the next 3 years, you're comfortable in paying, maybe a rate of 5.99
Yeah.
versus a variable rate of 6.14. Um, the thing that differentiates fixed and variable, aside from the obvious, is that a variable rate you can move around as you please in terms of there are no break costs with the lender if you find a different rate and you want to go to that new lender.
So in
With
case of refinance.
exactly.
Okay. Yep.
If you're on a fixed rate, if you lock in for 3 years, the bank then expects 3 years of interest. So if you
Mhm.
break at year one, the bank might charge you whatever the remaining interest is on that fixed period. So to
Oh,
leave,
okay.
which can be costly, but I suppose a lot of people are taking the advantage of a variable rate in that they, excuse me, they offer a 100% offset account,
Oh, yeah.
meaning that um, with any savings or additional income or additional funds, you can have that connected to your variable rate home loan and it offsets the amount of interest. So, for example, if you have a $500,000 mortgage and you have $50,000 as a balance in your offset account, I'm keeping in mind that the offset account, it's your money, it's a completely separate account. It can be used transactionally, like for arranging your mortgage repayments, any
Yeah.
debits and credits. Um,
All your groceries, all your everyday expenses, all can come out of the offset account.
all of that,
Mm.
exactly. So if you've got a $50,000 balance in your offset and a $500,000 mortgage, you're only being charged on $450,000 of principal, so to speak. So it's
Mm.
of offset. So you're reducing your interest. Um, There are some fixed products that offer an offset, but it's not 100% in that
Oh, that's interesting.
100% of your funds in offset aren't necessarily impacting your rate. And it's obviously less common that they're associated with fixed rate products because the advantage of a fixed rate is having that payment locked in rather than anything offset to reduce the interest.
Mm. Oh, I love offset accounts. The other day I was talking to one of my friends, um, and surprisingly, he just got a mortgage, but he didn't get an offset account. I was really shocked, and I was like, "Dude, you need to talk to your mortgage broker." Like, yeah.
Mate, again, it's circumstantial, right? And it comes down to how someone is structured with their
Mm.
spending or what their goals are. Because if you just had the loan account, what's built into that loan account on its own is a redraw function.
Yeah.
So you can make extra repayments
Yep.
into your mortgage over and above the minimum repayment, and you then build this balance of what's known as redraw. It essentially has the same effect as having an offset account or having a balance in offset in that it reduces your interest. It's just once you pay it into the loan, it's the bank's money.
Mm.
You retain that limit that you've paid over and above, so you can redraw that. But it'll be seen as taking it out as a loan again. You don't have to go through the process of getting a
Yeah,
loan
it's
to
more
read.
procedural, right? It's more painful.
Well, it's less transactional in
Mm.
that you have your home loan account. You can pay into that loan account or redraw out of it. You can't have um, it's less functional than an offset account.
Yeah.
Uh, and I think a classic example would be, if you have a balance in your offset and maybe you go out and out with some friends or whatever, and you have a balance in your offset, and it might be your round to get some drinks.
Yeah.
Would you be more inclined to pay for that round of drinks if you had a balance in your offset versus if you didn't have an offset account and you couldn't see that balance and it was
Mm.
harder to get the redraw?
Yeah.
Um, Maybe you wouldn't spend that
Mm.
amount of money on what your current activity is. So it comes down to, I guess, what level of financial discipline someone has and
Sure,
what they're
sure.
trying to do. But by and large, the same effect. Offset accounts are a very useful tool if
Mm.
you want to run your accounts transactionally.
Yeah, I got your point there because in the offset account, it's there and you can see it. And then obviously, if you're not financially disciplined, you can go out and spend it. I think that's the same case with credit cards, right? At the end of the day, it's your money. You got to pay it. And, you're the one who's losing out. So, yeah, I get that point. All right. Okay, so this one's an interesting one. With all the trends you've seen with the councils and the mortgage, broker industry and the property real estate space, obviously things are not ideal. They will never be. Um, if Zach became the prime minister for one day, what would you change? The one thing you had to change, what would that be?
Wow, what a big question. If I became prime minister for one day, what a day that would be. What would I change? Um, I suppose it's hard to put my finger on, but I will maybe reflect on what was a very brief initiative by a previous state government. There was an increased limit for first home buyers. So I guess we talked about the average age of a first home buyer being 39 years old.
Yeah.
Um, and by that point, some people are on bigger incomes than what the current eligibility criteria stacks up for any first home buyer discounts to be. And they're probably looking for properties that are, over 900,000. They might be, up to 1.5 million. So there was an initiative. I think it went from the 1st of January 2023 until the 16th of June before there was the state government change last year.
Hmm.
Um, and that allowed first home buyers to um, opt out of paying stamp duty on property values up to $1.5 million,
Mm.
um, in lieu of opting in for an annual land tax.
Yeah.
And what was interesting about that is, on a couple of points, is that a first home buyer, I think the statistic was they generally, will sell that property in 7 to 10 years or upsize or change their living scenario.
Yeah.
So, in 7 to 10 years of paying land tax versus the upfront stamp duty on a purchase price of 1 million to
Mm.
1.5 million, there's still something like, I think, like 8 or 9 years ahead or better off paying the land tax versus the stamp duty amount associated with that purchase price. So um, that's probably one of the things that I'd like to see again. And maybe a bit more of a discount for investors and what the lending requirements are around investment properties. As you know, there's a higher rate that's associated with borrowing for investment purposes,
Yeah.
um, and I suppose the crisis that everybody is got at the front of their mind being the housing supply and the rental crisis and the cost of living. Um, with rents that have continued to go up, so have mortgage rates and mortgage repayments, and a lot of the rental properties are owned by investors. So
Mm,
if there were cheaper mortgage rates for investors, then maybe the rental prices might be less. So that might be something else to consider. If I was prime minister for a day, to reduce the mortgage rates associated with investment properties because it delivers that service of
yep.
housing.
Yeah. Well, you got some two kind points there, so you've got my vote certainly. If you ever run.
Oh, I don't know if I could deal with it, mate. It's yeah, not sure if it'd be worth all the hassle. They've got a lot on their plate being the top of the tree,
Yeah,
but
totally. It's easy to criticize, as public we do, but at the same time we have to see that's they're really walking on eggshells. It's pretty tricky there. Yeah.
exactly, exactly.
All right, Zach. So, what does a typical day in life look like for a mortgage broker, for someone who wants to be a mortgage broker?
Yep. So I guess I start off my day sometimes with a gym workout, but when I get into the office, it's looking at the latest news. So I've subscribed to the AFR. I
Yep.
think that's a very good current tool just to see, current affairs in, the finance or the state of finance, so to
Yeah.
speak.
Thank you
Um,
for the promotion there.
yeah, no, it's very topical, very topical. And then, I'll clear any urgent emails that have come in overnight. As a mortgage broker, I guess, um, you know, all my clients have their day-to-day jobs.
Mm,
So a lot of the responses I get are outside of regular office hours. So the 9 to 5 isn't really something that factors into being a mortgage broker. It's obscure hours, and I do work at different times to what people may think. But I guess after urgent emails are cleared, then I will do some proposals with
yep.
for clients that have submitted me their financial snapshot through the client form. And then generally in the afternoons, I like to do some calls, speak to my referral partners, speak to clients, speak to new prospects. Um, that's generally a good time because people have their mornings out of the way,
Yep.
and you know, it's time to take a bit of a deeper dive on whoever's new on the book and needing some assistance. So that's probably a typical day. I don't know if I've missed anything, but yeah, emails, proposals, and then new business or existing clients.
Are your weekends busy?
Generally, Saturdays I do a fair bit of work with some of my real estate agent partners.
Okay.
Obviously, they have their open homes on Saturdays. I tend to support them most weekends and support their clients and people who are coming through homes, just to be there for any immediate questions if there is someone that is abundantly keen on a property in the moment and they want to know what their borrowing capacity is. I'm there to help. Um, other than that, spending time with my partner and family.
Cool. So if someone wants to become a mortgage broker, what's the career pathway that they have to go through?
Yeah, great question. So the minimum requirements for a broker is, I guess, to get some sort of associate role is to have I think it's a fourth level certificate in finance and mortgage management. And after that, you can go and work in a brokerage and you can be an associate credit advisor or an assistant broker or a trainee. And
Sorry,
then,
Zach, I'll just cut you there. Sorry. Sorry. With that certificate you mentioned, um,
yep.
how long does it take and how many modules and what are we looking at? If you could break that down,
Oh,
please.
wow. I'll have to, let me see.
Oh, it
It
doesn't
was
have to
quite,
be like, accurate. Just a. Just an
Yeah, I
idea.
think I think the certificate was that about a year? I think that was 1 year, and then the diploma, which was the next step,
Hmm.
diploma finance and mortgage management, was another year.
Okay.
Um, and that's all while learning and applying what we've learned in the industry. So you're getting hands-on experience with exactly what you're learning. One of the key requirements entering into the industry is having a mentor or having a couple of mentors. So someone who is experienced in the industry to guide you through how you conduct yourself, all the compliance requirements, knowing the banks, delivering the service to the clients. Um, that's a 2 year mentorship with an experienced broker. And I mean, then it's really up to you in terms of meeting certain CPD requirements every
Yeah,
year. Um, but that's pretty much it.
pretty cool. Thank you, Zach. That was a lot of information for a Saturday morning. But thank you.
Well,
That
good.
was really knowledgeable, and I'm pretty sure all the listeners will derive a lot of value from it.
Yeah, I hope so. I hope that's given some insight into, yeah, the state of finance.
Yeah, if someone wants to reach out to you, if they want to contact you, so where are you available?
I'm available on the Shore Financial website. So
Yep,
Shore Financial, SHORE, financial.com.au.
yep,
Um, Otherwise, I guess they can reach out to you and ask for my contact details.
totally. I'll put them in the description below as well and on the screen for if anyone wants to reach out to Zach. He's a wonderful guy. Take my word for it. So yeah, thank you, Zach, for your time, mate.
Thanks for having me, Abby. You enjoy the rest of your weekend.
Cheers, buddy. See ya.
Take it easy.